Welcome back to Investing Talk Podcast.
Today we're looking at Bitfarms. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Okay, so if we start with the financial picture, the first thing that really jumps out is scale. This company, it's gotten big.
Big how? Like, what are the numbers telling us?
Well, we're looking at trailing 12 months revenue, TTM.
Right.
And that's clocked in at almost $246 million. So size, global reach.
Yeah.
They're definitely a significant player.
Okay, nearly $250 million in revenue. That sounds impressive. But where's the profit? That's the disconnect I'm seeing.
Exactly. That's the challenge. Despite that scale, they reported a net loss of $86.20 million TPM.
Wow, $86 million.
Yeah. And that translates to a negative earnings per share, an EPS of negative 17 cents.
So huge operations, geographically spread out,
Yeah.
but still losing quite a bit of money. What's going on there? Is it just costs?
It's largely cost management and, the broader mining economics post-halving. Everyone's feeling the margin squeeze.
Right, the halving hit margins hard across the board.
It did, and for them, it shows the difficulty isn't just bringing in revenue, it's managing those power costs and hardware depreciation efficiently across, Canada, the U.S., Paraguay, Argentina.
Multiple jurisdictions, multiple complexities.
Precisely. Even with access to what they claim is low-cost energy, the cost of running those machines is still, it's outpacing the mining revenue right now.
Okay, so persistent losses.
Yeah.
Yet, analysts seem pretty bullish. We're seeing moderate buy, even strong buy ratings. Price targets are getting hyped up towards $7 by places like B. Riley, Northland.
Uh-huh.
What are they seeing that overcomes an $86 million loss? What's the competitive advantage, the moat here?
Yeah, it's a fair question. The analysts, I think, aren't really betting on the current mining operation as much as they're betting on the underlying infrastructure.
To physical assets.
Exactly. The advantage is that global footprint. Canada, U.S., Paraguay, Argentina. That spread gives them options for finding low-cost power and reduces localized risks. That's hard for a newcomer to just build overnight.
So the moat is the existing infrastructure network.
Largely, yes.
Yeah.
And that leads directly into the real story here, which isn't just mining anymore.
Okay.
It's how they're repositioning the entire business. They're leveraging that energy infrastructure for something else.
Right. The pivot towards AI-related power demand. That's where it gets interesting.
Very interesting. They're strategically shifting from being, a pure crypto miner, a commodity play, really towards becoming a more diversified data infrastructure provider. They're targeting that huge demand for high-performance computing.
HPC.
HPC, yeah. And data center capacity in general. It's a move driven partly by necessity, given the tough mining margins, but it's enabled by the assets they already have.
And the key asset enabling that is the massive energy pipeline, right? That 1.4 gigawatts.
That's the crown jewel. We really need to emphasize the value of that. 1.4 gigawatts.
Oh. I mean, think about it. Big AI companies, cloud providers, they're scrambling for power, consistent, reliable, affordable power for new data centers. That much capacity is, it's incredibly valuable, scarce even.
Exactly. It makes them instantly interesting to big tech. They can potentially step into a sector with much, much higher margins than just mining Bitcoin.
And it's not just talk, is it? They've secured funding for this pivot.
Right. That's the crucial piece. They got a private debt facility which converts into $300 million in financing.
$300 million from Macquarie Group, wasn't it?
Yes, from Macquarie.
Huh.
And it's specifically earmarked to fund their first big HPC project, the Panther Creek campus development.
So that $300 million, it's like a stamp of approval from the market. It says this transformation strategy might actually be credible.
It definitely signals serious intent. They're aiming for those high-margin data center deals, using that low-cost power as their sort of hook.
Okay, so that covers the strategy shift. Let's look at the market side. Back to the original question. Is it a good time to buy now? What's the chart telling us?
Technically speaking, the overall picture looks, pretty bullish. The stock's trading clearly above its 50-day and 200-day simple moving averages.
The SMAs, yeah, so confirms an established uptrend, technically.
Right. A longer-term uptrend seems to be in place.
Wow, the volatility, this is not a stock for someone who wants a smooth ride, is it?
Definitely not. Not for the faint of heart. We've seen almost 30% volatility just in the last 30 days.
30%. And the beta.
The beta is huge. It's 4.44.
Okay, let's bring that down. A beta of 4.44 means?
It means it's extremely sensitive to the overall market. If the S&P 500 moves say just 1%, this stock is statistically expected to move over 4% in the same direction.
So highly leveraged to market sentiment and any news.
Exactly, which explains why we've seen these explosive moves like that 12% jump in a single day recently, probably tied to strategy news or those analyst upgrades we mentioned.
What's kind of surprising, though, is that even with that big run-up and all the volatility, the RSI isn't screaming overbought.
Correct. The 14-day RSI, the Relative Strength Index, is sitting around 45.77. Pretty neutral.
Which suggests?
It suggests that, technically, there might still be room for more buying pressure before you'd expect an immediate sharp pullback based on that indicator alone. The chart doesn't look dangerously extended right now, despite the moves.
Okay, so bullish trend, high volatility, but not necessarily overbought yet. Now, what about looking ahead? What are the key things investors should be watching for in the next, say, 3 months?
The next few months are actually critical, pivotal, really. There are several specific catalysts coming up. First, the Q3 earnings report. That's scheduled for November 12th, 2025.
Right, Q3 earnings. That feels huge.
Yep.
What are we looking for there specifically?
Two main things. One, cost management. Are they starting to get those operational losses under control, especially after the halving? If they're still bleeding cash significantly despite claiming low-cost power.
Then the market's going to start questioning that whole competitive advantage story.
Exactly. And two, progress on growth targets.
Yeah.
They have this ambitious goal, right? 35 exahashes per second.
Yeah.
35 EHs in mining capacity by the end of 2025.
That's a big number.
It is. They need to show clear, tangible progress towards that in Q3. If not, it raises serious questions about their ability to execute on their expansion plans overall.
Okay, so earnings are key for mining efficiency and growth proof. What about the big pivot, the HPC stuff, that $300 million project at Panther Creek?
Also crucial, we should expect updates around mid-November, maybe into December.
Right.
What we need to see are concrete construction timelines, and most importantly,
Contracts, signed deals.
signed deals. Proof that this move into HPC is actually attracting tenants, preferably high-margin ones. The market needs to see that this isn't just a plan, it's becoming a reality.
And that ties into the buzz, the speculation, doesn't it? There's chatter about big potential partnerships.
Yes, there is. And it seems reasonably credible. The market chatter suggests they might be in talks with hyperscalers, the big cloud providers, or major AI companies.
That would be massive validation.
Oh, absolutely. A major partnership using that energy infrastructure for HPC workloads. That would instantly legitimize the whole strategy and probably justify those higher analyst price targets.
Okay, it sounds exciting, but we have to be balanced. Let's talk risks. What could derail this? What are the biggest red flags?
Number one risk, and it's company-specific, is simply continued net losses. If Q3 comes out and they're still deeply in the red, market patience could wear thin very quickly, especially given the pivot narrative is what's supporting the stock right now.
And that high beta, the 4.44 we talked about, that means any bad news gets amplified, right?
Hugely amplified. The downside could be just as sharp as the upside we've seen. Volatility cuts both ways.
What else? They're still heavily into crypto mining, aren't they?
They are. So they still carry significant exposure to Bitcoin price swings. That's totally outside their control. A big Bitcoin correction could easily drag the stock down, no matter how well the HPC pivot might be going internally.
Makes sense. And the pivot itself. Building data centers isn't the same as mining Bitcoin.
Absolutely not. That brings us to execution risk. It's immense. Taking that $300 million and successfully building out a high-performance data center campus requires totally different expertise.
So delays, cost overruns.
Delays, cost overruns, failing to sign up those tenants quickly enough, any of that, especially with the new debt they've taken on, could lead to over-leverage. It could cause the whole investment case to, well, fall apart.
Okay, so pulling it all together, what does this mean for you, the listener, trying to decide about this stock?
I think the investment thesis at its core is really a bet. It's a bet on management's ability to navigate this really tricky strategic shift. Pulling off the move from just mining into being a diversified energy and data infrastructure provider, it's ambitious.
That $300 million gives them the firepower to try.
It does. It gives them the financial muscle.
Yeah.
But it also raises the stakes incredibly high. Failure is now much more costly.
So who might find this attractive?
Well, you could see how it appeals to traders, right? People
Yeah.
looking for those quick, volatility-driven gains. And maybe also to long-term investors who really believe in the future demand for AI and data centers.
Yeah.
And they see this company's energy assets as key. But that sensitivity, that beta, means you absolutely have to watch those Q3 earnings like a hawk, especially the costs.
So the fundamental question really boils down to this. Can they get those high-margin AI or HPC partnerships signed and generating revenue fast enough to cover the losses from the traditional mining side?
That's it, exactly. That's the metric that will ultimately decide if those $7 analyst targets are realistic or just wishful thinking.
Okay. But let's leave you with one final thought to chew on. We've talked financials, operations, execution, risk.
Uh-huh.
But think about companies pivoting from energy into data centers. There's often another hurdle: regulation.
Interesting point.
Given their diverse international operations, Canada, the US, Paraguay, Argentina, is there a hidden regulatory risk in one of those jurisdictions that could slow down or complicate deploying that critical 1.4 gigawatts? That might be the risk the market isn't fully pricing in yet. Something to explore.